This is Brent with Black Lion Capital Management and the U.S. Petroleum Report for Wednesday, February 18th, 2016, featuring Update Analytics. We'll incorporate data from the Update Energy Feed, the Energy Information Administration, Baker Hughes, and CME Group NYMEX. Highlights from this week's report: we have our second week of a production decrease, and we're still at a century-low total rig count. Commercial crude oil, it added more than 2 million barrels to storage and established a new record. Cushing, Oklahoma, and total petroleum storage both set new records. Gasoline's at record storage, and it's coming to the end of seasonal strength. Let's go to the charts. U.S. continental production for the lower 48 United States recorded its second weekly decline, now down to 8.6 million barrels per day, below the 52-week moving average of 8.2 million barrels per day and well below the previous record set in 2015 of 9.2 million barrels. Perhaps the declining exploration and production activity in the rig count is beginning to show up. This potentially in the longer run could begin to support prices. For U.S. field production, this includes Alaska, a similar story to U.S. field to the lower 48, down to 9.1 million barrels per day. The third weekly decline, below the 52-week moving average and well below the 9.6 million barrel per day previous record. However, we still are adding commercial crude oil to storage. This commercial crude oil includes or does not include the Strategic Petroleum Reserve. This week, the 2.1 million barrel increase gets us to a new record of 504 million barrels of commercial crude oil in storage. We take a look at a seasonal comparison. In the top pane, we have the last 12 to 14 months of commercial crude oil storage. The silver dash line is the 10-year average of commercial crude oil storage. The delta between those two, either a surplus or a deficit, is displayed as a bar graph in the bottom pane. Very easy to do this in Update Analytics. And 186 million barrel surplus in commercial crude oil storage relative to the 10-year average. Mentioned at the top of the report, Cushing, Oklahoma. This is the physical delivery point for NYMEX light sweet crude oil futures, a new record of 64.7 million barrels. Total petroleum storage, we talk about this nearly every week, includes commercial crude oil plus the 12 refined products tracked by EIA. You can see where the previous record was back here in 2014, and every week nearly we set a new record, and we have again this week. Exploration and production activity continues to decline. This is the Baker Hughes rig count, United States only, rotary rigs focused on oil, down to 439 rigs after stacking out 28 last week. The brown dashed line that extends backwards there, it goes back and intersects the previous rig count of February of 2010. So this is the lowest we've been in the past 6 years. The total rig count tells a much more bearish story for exploration and production activity. We're down to 514 rotary rigs operating in North America, exploring both for natural gas and oil, and we have to go all the way back to August of 1999 to find a similar level. So this is a century-low rig count, and we were able to see that apparently this exploration and production activity decline is beginning to show up in the production data with the two weeks of decreased production, both in the lower 48 and the U.S. field production. Over to oil pricing. In the top pane, we have NYMEX light sweet crude oil futures. In the bottom pane, the 10-year weighted average of seasonality. We are in a time of year, as you can see down here, where we do experience seasonal strength, and we have seen some of that so far. This is the daily cloud chart we look at each week. This is a eSignals continuous chart, so this is not roll adjusted. Some things that we look at on here, both the price and then the blue lagging line are well below the cloud spans. The cloud spans are negative. You can see that highlighted in pink. The turning line is below the standard line, but we do have the prices above the turning line, the first time that's happened in the past couple of reports. I highlighted along the bottom here 26. That's the green dashed line there. We've come down and touched that twice and found support, and we're also experiencing the seasonal strength. It gives us some reason to believe that 26 could hold support, could hold. David mentions this in his charts this week, which I highly recommend you subscribe to as well. Shift T and that takes us over to a 3-box reversal 1% log chart. And consistent with what we saw on the cloud chart, we're well below bearish resistance here, several intermediate downtrend lines, and then 3 active downside targets. So one at $24, and then down here at $15.40 and $13.30. Those seem extremely low, but we certainly can't discount those given how negative the overall trend is for NYMEX light sweet crude oil. The 60 minutes point and figure chart, so this is a 10-cent box size, 3-box reversal. You can see down here where the $26 comes in. Actually, it prints as $26.40 on this chart. You have a little bit more fidelity with a 60-minute time frame. We can see where we've held that twice, have been making this series of higher highs and higher lows. We did break above this bearish resistance line earlier today. However, in point and figure, to properly adhere to the discipline, we need to see a new buy signal above that bearish resistance line before we will begin to draw the bullish support. No active targets on this chart, so this is a time somewhat of indecision with the actual pricing here without having any of the active targets. The actual futures, this is CLJ16, so this is NYMEX light sweet crude oil futures for April delivery. You can see I've highlighted here, these actually traded down to about $28.85. Realize that there is a difference because of the slope of the forward curve between what we'll see on the continuous print and then we'll see in the actual futures. We had a breakout earlier this morning. As soon as the report printed, I think a lot of people were taken by surprise. A lot of expectations of a decrease in crude oil storage based on possibly some API data. Clearly that wasn't the case with a new record set for crude oil storage, and we descended back down, right now trading at $33 on the April delivery. Dollar correlation is something that's very important to look at with light sweet crude oil, since it is an internationally fungible dollar-denominated commodity. In the top pane, we have NYMEX light sweet crude oil futures, again, E-Signal's continuous contract. In the center pane, we have the U.S. dollar index. This trades on ICE. And then we take an all-time correlation between these two instruments, analyze that in Update Analytics, and we see we have an inverse correlation of -80, which is intuitive. Then what we do to take a look more at the short-term correlation in the bottom pane, the heavy brown line, that is just the last 65 days, so approximately the last 3 months of trading activity between the two instruments. And you can see that all through 2016 so far, we've trended more and more positive with a short-term positive correlation to the dollar. Zooming in here, you can see when the dollar was trending down from the first part of February, crude oil was doing similarly. In the past couple of days, the dollar index has had a slight bid, and we've seen similar action in NYMEX light sweet crude oil futures, and that's contributing to this positive correlation. It's important to note that, but please keep and bear in mind that when you go back historically, the all-time correlation to this is negative, and that the few times that this has trended positive, it's been temporary, and it tends to very quickly return back to its negative correlation that's historically intuitive. Ultra-low sulfur diesel fuel this week added just 1.7 million barrels. However, that did not set a new record. Over to the seasonal comparison of ultra-low sulfur diesel fuel, you can see the slight build that we had last week. The difference in this chart is the blue dash line is a 5-year average of storage, and then the delta between the two, 35 million barrel surplus. The seasonal trend in ULS diesel mirrors that of light sweet crude oil, but we are coming to the end of it for the refined products, and we'll see that even more pronounced in gasoline. When the daily cloud chart for ULS diesel, similar story to what we saw in crude oil. Price and the blue lagging line both well below the cloud spans. The cloud spans are trending negative. In this case, though, slightly more short-term bullish picture. The turning line is above the standard line and the price is above the turning line. However, still in the long term on this daily chart, this is a very negative trend. Shift T and the point and figure daily chart shows us the same thing, same construction as we looked at in light sweet crude oil futures. It's a 1% logarithmic chart, 3-box reversal. well below bearish resistance, a couple of upside targets and no downside targets, so this picture is slightly more bullish for ULS diesel. However, the long-term trend consistent with crude oil is negative. The 60-minute point and figure chart, this gives us a little more fidelity. We did come up and violate this bearish resistance line, but we did not give a new signal. We violated it again with a new buy signal. However, we are running into resistance at $1.11. Some conflicting price targets. We still have this one downside target here to about 81.5 cents, and then a positive price target up here to $1.32, or more than 20% above where we are. We are trading above bullish support, but we need to take out this $1.11 for this trend to resume up and have any chance of realizing that 20% upside price target. The actual futures, HOJ6, April ULS diesel. Somewhat similar to crude oil. We were trading up here about $1.12 when the report printed, sold off with the overall build in petroleum products, finding a little bit of support at $1.09, but actually relatively quiet trading today. The one-to-one crack spread, this just takes a very gross look at the difference between NYMEX light sweet crude oil futures and ULS diesel futures. Earlier in the year, there at the end of January, we came all the way down to nearly $8 between the two, and that's expanded now to $14.72. That's, of course, intuitive given the fact that the daily chart for ULS diesel is slightly less bearish than what we've seen for light sweet crude oil futures. The forward curve for ULS diesel, go back 5 days ago, we are positive at all delivery points. Into gasoline, this was something we highlighted at the start of the report. 243 million barrels. That was the previous record set toward the start of the year for 2015. Well in excess of that, almost 259 million barrels. And you can see that literally down here for weeks, it's just been one storage addition after another. So, and that doesn't seem to be abating. Over to the seasonal comparison, same construction as we've talked before, last 12 to 14 months of storage in the top pane. We go back to a 10-year average for the light blue dashed line. The delta between the two shows a 28 million barrel surplus. That's quite a move up. We started the year with just slightly over 3 million barrel surplus in gasoline. Now well over 28 million barrels in gasoline. So we continue to build these refined products. That definitely brings into question some of the end-use demand for these products. Seasonality for gasoline, we mentioned this also at the early part of January, a very strong seasonal uptrend. We see that every year, but then what we see is then it turns sideways just as abruptly toward the middle or end of February. Coming here with our vertical line tool, you can see where we are today, that there's still just a little bit more seasonal strength left in gasoline, and then we'll begin to move sideways in the next week or two. Also, though, make sure to we have to understand and consider that what drives these seasonal trends is this is typically the time of year where that gasoline storage is built up in anticipation of the U.S. summer driving season. If we go back to the storage and look, since we've already exceeded a previous record and continue to set new records each week, some of the strength from this seasonal trend it can be called into question, and I think the fact that we've not taken out any of these previous highs during this time of seasonal strength kind of lends some credence to that the excess overhang of supply is helping to pressure gasoline prices. The daily chart for gasoline, this is the daily cloud chart. This is the continuous contract from eSignal, so not roll adjusted. This one looks a lot more akin to what we saw with crude oil. Once prices in the lagging line descended below the cloud back in the summer of 2015, it's remained that way all the way down. We are still have the price in the lagging line below the cloud spans. The cloud spans are negative. The turning line is below the standard line. So there's nothing really bullish or optimistic about this chart. Shift T takes us to the 3-box reversal logarithmic chart. Similar to what we saw with that cloud chart, well below bearish resistance. A lot of intermediate downtrend lines. One positive upside target, but this has not been activated yet. We would have to move above $1.04 for that to be active. On the downside, though, we have targets all the way down to 65 and 62 cents. With the downtrend and the continuous new record storage levels, it's not unrealistic to think that we could even realize those, although it's hard to imagine 60 cents a gallon for gasoline. That could easily translate into $1 or so at the pump. The 60-minute point and figure chart, similar story to what we just saw. Most important, we came up, bounced off the bearish resistance line, back working well below that. No active upside targets on this time frame. We have several downside targets, an 85-cent target from back in September of last year, 73 cents, 69 cents, a 76-cent downside target that's not activated yet, and then a near-term 96-cent target. We'll have to realize that before the rest of these come into play, but working below this bearish resistance into this downtrend, that seems realistic and possible. To the 15-minute, this is April gasoline futures. The curve is trading in contango, so these will be priced higher than what we're seeing on the index values. We were in this consolidation pattern this morning when the report printed, broke pretty abruptly below that, and this previous support turns into resistance, and that's holding here in the short term. The 1-to-1 crack spread for gasoline, this works formula-wise the exact same as what we've seen with diesel fuel. This just takes the difference between NYMEX light sweet crude oil futures as the input and then the gasoline futures as the output. Looks at the gross profit between the two of those. Trading at $10.30, down well below $19. And if you see here previously, during that time of seasonal strength, go back to 2014, this trended all the way up to $28. 2013 hit an all-time up here around $42. And even as recent as 2015, we were up around $29. This year, that doesn't appear to be in the cards with that huge overhang of record storage surplus. This is Brent with Black Lion Capital Management and the U.S. Petroleum Report for Thursday, February 18th, 2015. We were delayed one day due to the President's Day holiday in the United States. If you have questions or comments about the report, please feel free to email me directly, brent@blacklioncta.com. I'd like to extend my thanks to Mr. Jamie Lockett. He had some good suggestions, and I'll look forward to incorporating those going forward. If you'd like to learn more about Update Analytics or the data via the Update Energy feed, please contact their sales team directly. Thank you, and have a good weekend.